Briefly on the legal side, the content of this video is for educational and informational purposes only. It does not constitute investment advice or a recommendation to buy. All analyses, models, and strategies represent personal opinions. No guarantee of accuracy or completeness is given. The full disclaimer can be found at the end of this video and in the video description.
Hello and welcome to our introductory video on individual stock analysis from Learn4 Finance. Today we unveil the absolute core of our channel. Axel, I believe I speak for many when I say, but there are already countless stock analyses from other finance YouTubers. Why should I specifically watch the analyses from Learn4 Finance? A previously unknown new finance channel on YouTube. Is it even worth it?
Hello Lisa, hello everyone. Is it worth it? Are you asking? Stock analyses are everywhere on YouTube, but how often do you really see what legends like Buffett, ONeil, or Lynch would think about your stock? At Learn4 Finance, we bring not only numbers, but also the superinvestor comparison, fair price zones, and the deepest balance sheet check at a glance. Join us now to dive even deeper. Our 3 steps analysis. You've never seen stocks like this before. A company is like an ocean. You see the stock price, the headlines, but the true treasures and the real dangers lurk in the depths. That's why we have developed this process, which leaves nothing to chance.
Okay, Axel, with the process title, you're already a world champion. But is there really more now, or just hot air?
Well, we'll see if I am a hot air pump, Lisa. Step 1. Fundamental deep drilling. Well, maybe others do that too. Step 2. L4F Price GPS, buy, hold, sell zone. Step 3, classification of stock valuation, Superinvestor Check, 15 investment legends in comparison. But I believe that in Step 2 and Step 3, this hasn't been seen that often so far. You know many stock analyses, but hardly anyone shows you how 15 of the greatest investors of all time would judge. We combine depth, straightforwardness, and the knowledge of stock market legends, so you truly understand stocks. So Lisa, let's get started now.
Okay, we are all eager about that. Lead us through Step 1, the fundamental deep drilling.
Very gladly. This first step rests on 3 solid pillars that provide us with a complete 360-degree picture.
3 pillars just for the first step? That sounds extremely comprehensive.
That's it. But keep in mind that we want to hold stocks for an investment period of up to 5 years. You should definitely invest some time in the analysis. Now, here is Pillar 1, Forensic Financial Statement Analysis. We interrogate the company itself and dissect the financial reports of the past years. This is our forensic analysis in 5 phases.
5 phases? What exactly are you checking there?
It begins with the first impression. We ask, were there any anomalies in the last financial year end? We check 3 things: punctuality, the auditor's report, and the tone of management. Then, in phase 2, we look back 5 years with the time series analysis. We want to identify sustainable trends. How stable is the growth? How profitable is the company? Is the balance sheet becoming stronger or weaker? Have there been management changes? And is the goodwill increasing through expensive acquisitions? In phase 3, we actively pursue irregularities and creative accounting. In phase 4, we follow the trail of the money in the cash flow analysis. And at the end, we summarize everything in a SWOT analysis and an initial course of action. After this first pillar, we have a clear picture of the company's internal health.
Okay, impressive. And the second pillar?
Column 2 is the analyst check. But we do not believe the analysts blindly. We subject their work to our own tough L4F scoring system. We use professional research reports as a foundation, but we dissect them mercilessly.
What does that mean specifically?
We analyze 17 individual categories, from the key indicators through the balance sheet to the momentum, and assign points from 0 to 5 for each. This reveals the contradictions. For example, a stock can receive a strong 4 out of 5 points in valuation, that is, the assessment. But at the same time, only 1 out of 5 points are awarded for momentum and technical indicators, because it is in a clear downward trend. Following this detailed scoring, there are then Step 3, our ruthless growth check, Step 4, the determination of the overall grade, and Step 5, our completely independent conclusion.
I understand. So you get a multifaceted picture and not just a blanket buy. And pillar 3?
Column 3 is the quantitative analysis, the mathematical reality check. This is our ultimate lie detector test. We translate the financial data into the hard, objective language of mathematics to answer the fundamental questions.
Give us an example.
Gladly, the analysts praise the high dividend. Our quantitative analysis examines, is this dividend really secure? Or is the high debt slowly eating up the cash flow? Order, everyone is talking about a great growth opportunity. Our analysis asks, is this growth just a flash in the pan because margins are falling at the same time, or does it have a profitable foundation? The quantitative analysis examines whether the often optimistic stories of analysts can withstand a tough reality check.
Shoo, that's really a deep borehole. Once it is confirmed after this process that the foundation is solid, what happens then?
Then comes the crucial question, Lisa. But even the most solid company in the world can be a disastrous investment if you pay too much for it. So the all-important question is, what is a fair price, and where is the stock today?
And that's step 2?
Exactly. Welcome to step 2, the L4F Price GPS. The biggest trap for investors is buying a wonderful company at an outrageous price. That's why we have a simple but extremely effective system that shows us at a glance whether a stock is currently expensive, fair, or cheap.
A GPS for the stock price, that sounds brilliant. How does it work?
The logic behind it is transparent and comprehensible. We take the well-founded earnings expectations for the next 5 years and combine them with the historical price tag that the market has attached to the stock in good and bad times. We calculate an optimistic and a conservative price target from this. And now comes the decisive added value for you. We translate these targets into 3 clear, color-coded zones.
Like a traffic light?
Exactly. The green buy zone. Here the stock is undervalued. The yellow hold zone. Here the stock is fairly valued. And the red sell zone. Here the stock has run hot and is expensive.
Can you show us this with a concrete example?
Absolutely. Let's go through this with the specific example of Kraft Heinz. Our analysis has identified the following zones. The buying zone lies between $24.64 and $30.03. The holding zone ranges from $30.04 to $40.80, and the sales zone begins at $40.81.
Okay, and where is the stock now?
With a current price of $27.41 US, Kraft Heinz is clearly in the green buying zone. Our analysis indicates an expected return potential of around 10.9% per year for the next 5 years. And here is a very important point. These 10.9% refer solely to the potential increase in the share price. The attractive dividend of nearly 6% is an additional bonus. The total return, therefore, amounts to 16.9% per year.
That is a crucial clue. And what is your conclusion regarding the price analysis?
The conclusion of our price analysis. The Kraft Heinz stock is attractively valued at the present time. It is fundamentally inexpensive, even though the absolute potential for price increase remains limited due to weak earnings development. This makes it particularly interesting for investors who focus on value and high dividends. That's why Warren Buffett holds this stock in his portfolio. However, for those seeking dynamic price growth, there are currently more exciting alternatives on the market.
That is incredibly clear. So no gut feeling, no guessing. Just a clear, data-based answer to the question, is now a good time? But there is still a third step. What else can come now?
Exactly, Lisa. Everything we have discussed so far serves only one purpose. With the very in-depth analysis, we want to better understand and evaluate the company. Why? Because this significantly reduces the risk of an analysis error. And unfortunately, we do make mistakes repeatedly. Sadly, this is part of investing.
Wow, Axel, a really very honest statement from you. I believe you speak for many who have already invested in stocks from the bottom of their hearts.
And that's exactly why our investment process doesn't end here. That's why the masterclass is coming now. The final step that puts everything into the right context. Step 3. The L4F Superinvestor Check. We do not ask, what do we think? We ask, what would the greatest and most successful investors of all time do? We subject the stock to a stress test from 15 fundamentally different perspectives.
Cool. So you're inviting the legends to the table. Who, for example?
We start with the man where it all began, Benjamin Graham, the legendary mentor of Warren Buffett and author of the investment Bible, The Intelligent Investor. His ironclad rule was the margin of safety. He basically bought €1 for 50 cents. For him, a highly valued stock like Nvidia would be a prime example of a high-risk market speculation. His verdict? A clear avoid.
Okay, so the original father of value investing is out. What about his master student, Warren Buffett?
Buffett, the Oracle of Omaha, has developed Graham's ideas further. He is looking for wonderful companies at a fair price that possess a lasting competitive advantage, the moat. He would recognize Nvidia as a phenomenal company, but the price would be too high for him. His judgment would therefore also be avoid, but admire the company and wait for a significant price correction.
2 legends, twice avoid. That sounds clear.
Not so fast. Now we change the perspective completely. To a man who was the exact opposite, William ONeil. He developed the Can Slim system and searched for companies with explosive profit and sales growth. For him, Nvidia is the perfect Can Slim stock. Every one of its criteria is met with flying colors. His verdict would be crystal clear: buy.
Fascinating. So a complete contrast. Is there also someone who considers the psychology of the market?
Absolutely. Howard Marks. He popularized second-level thinking. He doesn't ask, will the company grow, but what is already priced into the current stock price? His second-level thought about Nvidia would be, everyone knows Nvidia is great. The price already factors in a perfect future without any disruption. The real risk, therefore, is not in the company, but in exaggerated expectations. His judgment: avoid, because investors significantly underestimate the risk.
That was now 4 out of 15 legends. What does the overall picture look like?
I would like to briefly return to your initial question. Am I a pump? And is it even worth subscribing to Learn for Finance and watching the stock analyses? Anyone who has made it this far has probably already recognized our added value. But perhaps with some lingering doubts, now comes the masterclass, Lisa. The final step that sets us apart from all other financial channels, the L4F Superinvestor Check. We ask, what would the greatest and most successful investors of all time do? We examine the stock from 15 different professional perspectives, each with its own principles.
That sounds like a real stock exchange, Olymp. Who all do you have on the scorecard?
1. Warren Buffett. Quality and fair price, 71% criteria met. Judgment: avoid. Buffett loves great companies, but not at any price. Currently too expensive for Nvidia. 2. Benjamin Graham. Deep value, 57%. Judgment: avoid. Margin of safety counts, and he doesn't see it here. 3. Peter Lynch. Growth at a reasonable price, GARP, 71%. Verdict: hold. He sees the potential, but the valuation is not clear enough to him. 4. William ONeil. Can Slim, 100%. Verdict: buy. He loves explosive gains, innovation, and momentum, and Nvidia delivers all of that completely. 5. Mark Minervini. High-speed growth, SEPA, 100%. Verdict: buy. Bets on trend rockets, and Nvidia is his flagship example. 6. Nicholas Darvas. Darvas Box, momentum, 100%. Verdict: buy. He follows the trend, and it points sharply upwards. 7. Joel Greenblatt. Magic formula, quality plus price, 50%. Judgment: avoid. He lacks the favorable valuation, despite a strong company. 8. Charlie Munger. Quality first, 90%. Judgment: buy hold. Focus on world-class companies, but more cautious than Buffett regarding entry price. 9. Philip Fisher, long-term growth, 93%. Verdict, buy. He looks for companies with innovative DNA and sustainable growth. 10. Seth Klarman, margin of safety and intrinsic value, 0%. Judgment, avoid. For him, Nvidia is simply too expensive and uncertain. 11. David Dodd, substance value, 0%. Judgment, avoid. He also sees no substance securities. 12. John Neff, low PE growth, 0%. Verdict, avoid. Only buy when growth is available at a reasonable price, not the case here. 13. T. Rowe Price Jr., growth investing, 100%. Verdict, buy. A fan of clear growth drivers, as demonstrated by Nvidia. 14. Howard Marks, second level thinking, 0%. Judgment, avoid. He sees the euphoria as a risk and stays away. 15. George Soros, reflexivity, macro, 90%. Judgment, hold, trade. He would follow the trend, but remains flexible at all times.
Wow, Axel. Hammer. Now we know them all. I have a quick question. Why did you choose Kraft Heinz instead of Nvidia for the Superinvestor Check?
Good job, Lisa. You're paying attention. I deliberately chose Nvidia here because it is held in many investor portfolios and has a clear growth story. I wanted to demonstrate that we can analyze any stock this way. Kraft Heinz would have been too boring for this comparison.
Thank you, Axel. Makes sense. Let's get back to the Nvidia Superinvestor Check. You've now presented all the super investors and their opinions. But what is the viewer supposed to do with that? Axel, don't say it. I was too quick. Because now comes the crucial part. What does the overall view show, right?
Bingo, Lisa. Exactly. Now comes the essence for the viewer at the end. The average across all 15 super investors is 61.5% criteria met. But this average is almost worthless. The real insights only come when we compare the investment styles. Value investing, 31.1%, almost all value icons say, avoid, too expensive. Growth investing, 88.0%. The growth gurus celebrate Nvidia as a prime example. Momentum, technical analysis, 100.0%, all in agreement, buy. Contrarian, cyclical, macro, 45.0%. High skepticism, risk due to market euphoria.
That is really next level. Now everyone understands why opinions are so far apart.
Exactly. Our scorecard shows you. Who says why, yes or no? Which investment style does the stock fit? What risks do you see yourself?
No one can really do that on YouTube. All opinions, all legends, all tables transparently in the podcast.
And that is our claim. Depth, clarity, perspective. You only get that with Learn4 Finance.
I understand. The added value is not the one correct answer, but that as a viewer, you see which camp the stock favors and why. You find your own style.
That's exactly the point. It's about providing you with the thinking tools and arguments from all camps. We show you the entire playing field. This way, you can make an informed decision that fits your personal investment style and your risk tolerance.
Fantastic. So let's summarize once again. Step 1, the deep drilling checks the foundation. Step 2, the price GPS determines the right timing. And step 3, the Superinvestor Check provides the perspectives of the masters.
Our Learn4 Finance 3-step analysis provides you with real in-depth drilling, objective evaluation, and the judgment of investment legends. No hype, no black box, just clarity, perspective, and tools for your own style. Comment below which stock we should analyze next through the 3-step process. Subscribe and leave a like so you don't miss an episode. Thank you for your interest and perseverance.
I also hope you enjoyed this introductory video, because now, in the upcoming podcast videos, the individual stock analyses are coming. See you at Learn4 Finance, your Lisa.
Disclaimer: the content on the YouTube channel Learn4 Finance is for educational and informational purposes only. All analyses, quantitative models, strategies, data preparations and content presented reflect solely personal opinions and interpretations. There is expressly no individual investment advice or recommendation to buy, sell or hold financial instruments within the meaning of Section 32 of the German Banking Act, KWG, or Section 85 of the German Securities Trading Act, WPHG. The information provided does not replace professional financial, tax or legal advice. The channel operator assumes no liability for the accuracy, completeness, or timeliness of the content. Viewers make investment decisions independently and at their own risk. Past performance, simulations or forecasts are no guarantee of future results. Important note, investments in financial instruments involve significant risks, including the total loss of capital. Please consider seeking independent advice from qualified professionals before making any investment decision.